Officially good afternoon, everyone. Thanks for signing on today. My name is Brett Sebion. I'm a financial coach at Emerge 360, which is a division of TrustPoint. Today, we're going to talk about some retirement readiness topics, review, plan, and optimize. Different things to think about as you're approaching retirement, or maybe you're in retirement, etc. But before we get started, we do various webinars throughout the year. A couple months ago, we did the new limits webinar as contribution limits, different income limits relative to being able to contribute to certain accounts changes year over year as the tax law is constantly changing. So we like to update people on that. We're doing the retirement readiness webinar today, a rollover webinar later in the year, and I believe we have one more retirement readiness webinar. So take up about 30 to 40 minutes of your time today, covering a host of different topics. But do want to give a brief overview of TrustPoint and Emerge. So TrustPoint has been around for many decades, been headquartered in La Crosse, Wisconsin that entire time. We also have offices in Minneapolis and Eau Claire. All in all, we have about 110 staff members. The majority of those folks are in the La Crosse location. On the upper right are all the services that we provide. So we administer 401k plans. We do individual family investment management, investment advice. We provide trust and estate administration services, also work with a lot of foundations and nonprofits in the communities that we serve. When you combine all the monies that we manage for the services that we provide, it's about 8 billion. Oh, whoops. Sorry about that. About 8 billion. And again, that's across all the services that we provide for folks. So this is the agenda for today. We fit in a current market update just because there's been a lot going on in the first, call it 5 months of 2025. Then we're going to talk about retirement basics, saving for retirement, spending in retirement, retirement benefits, and then next steps. So current market update. If you would have just closed your eyes January 1 and woke up today and looked at the price action, you really wouldn't think, there's been a lot of news, but within that time frame, there's been a lot that has happened. It's just the net impact has not been as bad as it was when we were in the middle of April or just about a month ago. So these numbers are through April. May has been a little better month, so these numbers look even a little bit better. But year to date, global stocks, which includes US stocks and international stocks, are down just slightly year to date. The next grouping, I'll call it the next three kind of sections here, are US stocks. And every single asset class within US stock markets have been negative year to date. International stocks, however, have kind of been the light in the investment universe, which has not been the case for the previous kind of 10 to 12 years. But so far in 2025, we've seen investors really gravitate to international stock markets and kind of shying away from US stock markets. So all in all, when you combine the two, we're slightly negative. But US stocks have definitely underperformed relative to international markets. So that's on the equity side. On the fixed income side, so if you are nearing retirement or in retirement, chances are you have some fixed income or bonds within your portfolio, and you definitely, should. As the older we get, the less risk we have to take on as investors, as savers. Generally speaking, the fixed income market has done. Oh, sorry. That is the wrong sections or the wrong snapshot. It looks like it got duplicated. So we're not going to cover that. But fixed income markets have generally done okay for the last, for year to date or in 2025, which is really what you want bonds to do when the stock market is volatile. But we're going to move on here to the second section. So I apologize for that. Retirement basics. So these are key dates to kind of think about. You really don't have to think about too much up until the age of 50. Now, we do always encourage people to increase their retirement savings every year, whether it's in 401ks, IRAs, and brokerage accounts, et cetera. But in the world of retirement saving, age 50 is kind of the first time you get to do something different. So age 50 is when catch-up contributions are allowed in IRAs and 401ks. In 401ks, it's a little bit higher of a increased contribution relative to IRAs, and we'll cover that. Age 55 catch-up contributions to HSAs. HSAs you can contribute to only if you are participating in a high deductible health insurance plan. 59 and a half is when you can start withdrawing monies from your retirement accounts without penalty. Now, anything that is pre-tax, you're still going to pay ordinary income tax on that, but you're not going to be penalized from a tax perspective. Age 62 eligible for reduced Social Security benefits. We have a section on that. Age 65 is when you can apply for Medicare benefits. 66, 67 is the majority of folks' full retirement age. Eligible for full Social Security benefits. Age 70 is maximum Social Security benefits available. And then 73, soon to be going up to 75 in 2030, is when required minimum distributions start out of your pre-tax retirement accounts, 401ks, IRAs, et cetera. And I'll talk a little bit about this, but when we do financial planning for folks individually, we send out, or we have men living until 92 and women living until 94. We're living longer, which is great, but that just means planning for a longer retirement becomes more important. So control in retirement. So like with, retirement and investing, such in life, you want to control what you are able to control and don't try to control what you can't, right? So things that we are unable to control as investors and as savers are market returns, tax policy, and healthcare costs, right? Those are things that are really completely out of our control. We can plan for them and plan for the unexpected, but we're unable to control those. Your full ability to control is your lifestyle, right? Especially on the discretionary spending, your vision of retirement, and asset allocation. So how you are invested, what you have your monies invested in across different areas of the market. Again, we can't control what the market does, but we can control how we're invested, which is going to help within the planning piece when we are working leading up to retirement and in retirement. Then the middle section is just some degree of control, that you have, right? Longevity, lifestyle choices, duration of employment and earnings, and non-essential spending. How much will you need for retirement? So this the next couple slides are very general topics. Everyone's situation is different, so everything we talk about here is not gospel. They're really just guidelines. But how much will you need? It's based on different factors: longevity, healthcare costs, savings, and income needs. Healthcare costs is kind of a big, scary number. 157,000 estimated total healthcare costs in retirement for an age 65 individual. So if you have a spouse or partner, double that. Income needs, this is one of the metrics that the industry uses. 75 to 85%, kind of an income replacement ratio. So if your household income is $100,000 at retirement, the industry thinks you'll need about $75,000 to $85,000 each year in retirement. In a lot of cases, you might take a little bit more on the front end in your go-go years as you're traveling, and then as you get older, you're kind of slowing down, not needing as much, not spending as much. And we have another visual on the next slide that kind of shows the changes over time. But longevity is another important piece, and everyone's situation is different again, but always keep that in mind. So another metric that you might have heard, so we talked about 70 to 85% income replacement ratio. These are different checkpoints. So in absolute dollar amounts, kind of what you need along the way and what you might need in retirement. So you may have heard 8 to 10 times your ending salary in retirement. So if your household income is 100,000 at retirement, the industry believes you should have anywhere from 800,000 to $1 million in retirement assets. It's a big number. Some people are, I say that and they get scared or jump away. Again, everyone's situation is different, right? Debt, lifestyle, etc. But this is a good guideline to kind of, to help lead you along the way. So let's say you're 50, making $50,000 a year. At that time, the industry encourages you to have $250,000 or 5 times your salary in retirement assets. Don't forget inflation. From 2010 to 2020, we basically had no inflation. But then after COVID, with all the stimulus, supply chain issues, et cetera, inflation uh, came to light in a way that people had not experienced before. So just understand the impacts of inflation. So this is a good visual that shows cash flow needed today to maintain purchasing power of $100,000 in today's dollars at 3% inflation. So basically $100,000 today, forecasted 30 years out into the future, if inflation is 3% a year, that 100,000, or it is now basically 242,000, right? So that's just your purchasing power being kind of eaten away over longer periods of time. And this is why it's important to have an investment objective that aligns with what you need to spend in retirement and what your distribution strategies are, right? If you have $100,000 and it's just sitting in a checking account earning nothing, and you want to use that for healthcare, and healthcare is going up by 5%, 6% a year, your real purchasing power relative to that example is declining. So keep that in mind. Don't forget about inflation, and don't make these mistakes. These are things we see all the time. We work with a couple hundred 401k plans. We work with 14,000 participants. And then in addition, we have individual clients, and these are just, things that we have seen over the years. Saving too little, starting too late. This is why we really encourage people to increase their retirement savings each year, even if it's just by 1% a year. Retiring too early, we have a lot of people who, they come in and they say, well, I want to retire at 58, but their saving strategy and their spending habits don't necessarily align with the year that they want to retire. Underestimating longevity. So we are living longer. And a lot of people don't think they're going to live to a certain age, but the numbers say otherwise. And again, anything can happen. But a lot of folks do underestimate longevity, and also future healthcare expenses. When we do planning for folks, this is one of the spending items that we have the highest kind of inflation number tied to it. The cost of healthcare continues to go up, and it's important that we plan for that. And then filing for early Social Security benefits. Early also meaning reduce. So again, we have kind of a couple slides in a section on this. So I'll save my comments for then. But we do see a lot of people just filing early, taking early, when really they might have been better suited if they would have delayed a couple years. And then saving for retirement, section 3. So how can you save for retirement? A lot of you are gonna, already know the different kind of buckets you can save money in, but we like to break it out into kind of 3 different ones: after tax, pre-tax, and no tax. So I want to start with the after tax bucket here. So these are brokerage accounts, individual joint accounts. We call them agency accounts at Trust Point. But brokerage would be another, term for it. Taxable income, so interest, dividends, and capital gains are taxable. Tax deductions, there's no tax deductions for the contributions that you make, and there's no limits on what you can contribute. Moving on to the pre-tax and no tax. So pre-tax is basically monies that you don't pay any tax on prior to making the contribution. So you get a tax deduction for it. You get to deduct it from your taxable income. So these are traditional IRAs, traditional 401ks, etc. It is taxable income when you withdraw those monies, whatever your ordinary income tax is at that time. Again, tax deductions, your contributions are tax deductible, and contribution limits, yes, specific to the type of account. We'll cover that on the next slide. The no tax bucket. These are Roth 401ks, Roth IRAs. You basically pay the tax up front, gross tax free. And then when you take it out, as long as it's a qualified distribution, there's no tax on that. So again, you don't get a tax deduction, but the monies grow tax free. And as long as it's a qualified withdrawal, you don't pay tax on that as well. There are contribution limits specific to the type of account. And again, we'll cover that on the next slide. But over time, it is good to have monies in each of these buckets so that when it comes time to taking money out in retirement, you have distribution options, right? You can implement different distribution strategies like we do with our clients, right? So you don't have everything in one bucket. For an example, a pre-tax bucket where everything you take out of that is taxed at ordinary income. So again, as you're going through your career, having distribution options in retirement is very beneficial. And these are the three different buckets that you can use to accomplish that. Excuse me. Maximize your savings. So traditional versus Roth. We're not going to go through all of this. But there are traditional IRAs, traditional 401ks, then Roth IRAs and Roth 401ks. There are still 401k plans out there that don't offer Roth. Roth within 401ks has not been around as long as just like the traditional 401k when it was created, or 403bs, etc. The one thing that I do want to point out is that there is income limits to allowing you to contribute to a traditional IRA or a Roth IRA, meaning that if you make a certain amount, we'll cover that on the next slide, you aren't able to contribute to a traditional IRA, or you're not able to receive the tax deduction for the traditional IRA, rather. You could still contribute to it, but you're just not going to get the tax deduction. And there's income limits being able to contribute outright to Roth IRAs. If you make too much, you can't even contribute to a Roth IRA. In the 401k landscape, those income limits essentially go away. You can make tons of money and still contribute to a Roth 401k. And also the limits are higher, which we'll cover on the next slide. So again, don't want to go through all of this. I will say deadline to contribute for individual IRAs, traditional or Roth, you actually have until April 15th of the following tax year to make those contributions, where 401ks, all of those contributions need to be put in by December 31st. And these need to be payroll deducted. So you can't just cut a check and deposit it into your 401k at the end of the year. It needs to come through payroll. And then these are the contribution limits. So if you were on the webinar at the beginning of the year where we talked about this, you've seen it for a second time. But the 2025 limits, and the main things I really just want to point out here is that the 401k contribution limits are a lot higher than individual retirement account contribution limits, right? So in 2025, if you're under the age of 50, you can put up to $23,500 in a 401k. Over the age of 50, you can put a $7,500 catch up. Again, this is just your personal contributions. There's a new provision that came out of the Secure 2.0 Act called the Super Catch Up. If you are 60, 61, 62, or 63, you can put an additional $11,250 instead of just the standard $7,500. And then contribution limits for IRAs, $7,000 if you're under the age of 50, $8,000 if you are over the age of 50. And then jumping down to the bottom, these are the income limits that I briefly mentioned when contributing to individual retirement accounts. So 2025, you can see whether you're single or married, filing jointly. For traditional IRAs and Roth IRAs, these are the income limits. So again, this is your MAGI, so your modified adjusted gross income, taken into consideration your standard deduction and maybe other deductions that you have. And it's phased out, right? And this always changes. So we do always encourage people to work with your financial advisor, work with your CPA, to make sure that this is kept in check, and that you're following the limits that the IRS outlines. All right, so that was saving in retirement, or different retirement topics. The next section here is spending in retirement. So the first couple things I want to talk about are risk tolerance and asset allocation, because that really plays into distributions and your spending strategies in retirement. So this is a good snapshot of generally how your allocations should look and change when you're working, when you're in retirement, and then afterwards. So when you start working, you really want to be invested aggressively, right? Because being invested aggressively, meaning invested in the stock market, is going to give you the potential to have greater returns relative to being invested in bonds or cash. And it's more volatile, right? It's going to go up and down more. But when you're young, you're not retiring the next year. So if markets go down the next year, that really has no impact on your future self. So the closer you get to retirement, which is this green dotted line, you want to see your stock market exposure go down, your bond market exposure go up, and that same kind of trajectory following into retirement. Um, a lot of people think that I retire, I'm just going to put everything in bonds or everything in cash and I'll just live off of that. Depending on what you need to spend, and this is probably the majority of people, that's not a great strategy. You want to find a balance that still allows your money to grow, but you're not taking on the amount of risk you were taking on when you were working. So again, if you're working with a financial advisor, this is something to pay close attention to, especially if you're 5 to 7 years kind of into retirement, or an investment cycle away from retiring, and making sure that your asset allocation aligns with your goals. So asset allocation, said it a few times now, very, very important. It's the overall mixture of stocks, bonds, and cash that you have in a portfolio. And this is way more important than stock selection. Stay invested, right? Don't try to time markets. If you have 100% of your 401k in stocks and you're retiring next year, now might be a good time, as markets have rebounded, to reevaluate that, right? And shift to something that aligns more closely with your time horizon and different goals you have in retirement. So you don't want to be invested too aggressively. You also don't want to be invested too conservatively, right? Because that's, the loss of purchasing power, right? When you're factoring in inflation, cost of living, et cetera. Grow your emergency fund. So when we're working, we always talk about, 3 to 6 months of living expenses, saved up as an emergency fund. We have a lot of clients who, grow this emergency fund 12 to 24 months of expenses when approaching retirement. Again, a little extra nest egg as you're now taking from your assets and you're no longer accumulating. Also, it provides some flexibility with, taking distributions out of retirement accounts. For example, in 2022, markets were down, stock markets were down 20%, bond markets were down 15%. For clients that had increased cash levels, we were able to draw on those cash levels, not take from their retirement accounts, and allow their retirement accounts to rebound without taking from them, right? And then when markets rebound, we were able to replenish the cash bucket. So it's good to increase that emergency fund the closer you get to retirement and in retirement, not because of just you're now in the distribution stage and not in the accumulation stage, but it also provides flexibility around distribution strategies, especially when markets are volatile. Effects of withdrawal rates and portfolio allocation. So we're not going to go through each one here, but the main story to take away is that depending on your withdrawal rate on the left-hand slide, there's confidence levels used when we do planning relative to how you're invested, right? So if you have a 5% withdrawal rate, meaning you're taking from 5% of your assets. If you have $1 million portfolio, you're taking 50 grand a year. You don't want to be invested in just fixed income or majority fixed income and a little bit of stocks. The confidence level in not running out of money is not going to be very good, right? So you want to be invested a little bit more aggressively, 50-50, 60-40, maybe even 70-30, depending on your risk tolerance. That puts that confidence level higher based on your withdrawal rate. So let's say you're taking 6% of the account each year. Basically, if you're invested 40% stocks, 60% bonds, not very high confidence. 80-20, right? Still not super high confidence, but giving you a better shot than if you were invested more conservatively. So again, everyone's situation is different. We have clients that have a 3%, 4%, 5% withdrawal rate, and how you're invested matters. I always say returns become less and less important the older we get. What becomes more important is how we're invested based on what our distribution rate is going to be and the spending that we're doing in retirement. And then budgeting in retirement. So this is something that is included or it's involved in our financial planning process. What are our clients spending? Are they buying a new car every 10 years? Are they going on a trip every year? Do they plan to downsize, et cetera? How does your budget look? How does it change? So you want to look at your fixed household expenses, right? What you absolutely need to spend money on, your discretionary expenses, your extracurriculars like traveling, going out to eat, healthcare costs, right? Take a close look at this, whether it's through your employer, marketplace, Medicare, and then identify your assets and income sources, right? Social Security, pension, that's in addition to just general retirement, employer plans like 401ks, 403bs. This is a very important component in retirement, especially going through financial plan, is building in your budget and how that looks. And then retirement benefits. So one of our last sections here, the first thing we're going to talk about is Social Security. So choosing when to begin your Social Security benefit. This is a loaded question. It's an art and a science. But generally speaking, if you take your benefit at 62, it is a permanent reduction. Every year you delay, up to age 70, you are getting an 8% annualized additional benefit. So even delaying from 62 to 67, that'd be like increasing your monthly Social Security benefit from $1,000 to $1,400 a month. So that's pretty impactful. That doesn't mean you shouldn't take it at 62. It just means a lot of people, especially as we're living longer, are going to benefit from delaying and receiving that annualized benefit. So again, you can start at 62, goes up, as late as age 70. Most people's full retirement age is around that 66 to 67. But here are some different factors to think about: life expectancy, income needs, health insurance, spousal benefits, changes in employment, family benefits. So here's a kind of a cool example, evaluating a break-even age with hypothetical illustration here. So this is an individual, this is their Social Security benefit at age 62, $2,700, age 67, and age 70. So obviously the amounts go up the older you get. You're receiving that annualized, benefit. So takes you through an example of, when is the most optimal time to start taking this benefit. So going to go through the kind of key takeaways here. So the deferred benefit: if the individual believes that there is a strong chance of living well beyond age 84, then they may benefit from delaying benefits until age 70. Normal retirement: if the individual instead believes that age 84 is unlikely, but living past age 77 is probable, then they should consider benefits at full retirement age, again in that 66 to 67 age range. And then early retirement: if the individual believes reaching age 77 to be very unlikely, then they should consider collecting benefits early, because the total, let's say you die at age 77, the total benefits that you collect at age 62 and beyond surpasses the amount you start collecting at age 70 or 67. Even though it's a higher monthly amount, the total is still greater, again, if you were to pass away at age 77. So we always joke, if people know the second date on their tombstone, planning would be a lot easier and a lot more seamless. But this is something to start thinking about if you're approaching Social Security age. Again, generally speaking, most people are going to benefit from delaying at least until full retirement age, especially as we're living longer. Social Security. So there, every once in a while, this is in the financial media. There's a lot of misconceptions, going around, and want to touch on a few of them here. But Social Security is growing, is going broke. So, without any changes, the trust fund is estimated to be depleted by 2034. But remember, Social Security is a pay-as-you-go system, right? So as long as people are contributing and still kicking out benefits, there's things structurally that can change and probably will change prior then to them just saying, okay, nobody is ever going to receive Social Security benefits again. So how it is currently structured, yes, the fund is estimated to be depleted by 2034. Full retirement age at 65 for everyone, false. Full retirement age depends on your birth year, and it generally varies between 65 and 67. Social Security will replace most of retirees' income needs. False. A lot of people, unfortunately, are only going to rely on Social Security benefits, but in the financial advising world, it's really only meant to replace a third of your income. The remaining 2/3 need to come from retirement assets, 401ks, IRAs, brokerage, joint accounts, etc. Earned income is not allowed while collecting Social Security benefits. There's a lot of confusion around this, so just kind of want to read, verbatim this fourth section, that individuals can continue to work after receiving the benefit. If they select Social Security benefits before full retirement age, and has an income which exceeds the earnings limit, which changes every year, then a portion of the benefits will be reduced. However, the benefits which were reduced due to the earnings limit will later be credited back. And then last part here, there's no earnings limit upon reaching full retirement age. So again, there's a bunch of kind of different rules, within this. We're happy to talk through them with folks, but these are some common misconceptions that we see from folks. And then briefly on, Medicare here. So Medicare starts at age 65. A lot of people think Medicare is free. It is not. You still have to pay Medicare premiums, and depending on kind of what part you select, there might be different costs associated with that. So Part A, B, C, and D. A is hospital insurance, free for people 65 plus who paid payroll tax for 10 years. Covers care like hospitals, skilled nursing facilities, etc. Part B helps cover physician, doctor services, outpatient care, home health care, etc. Part C, Medicare Advantage, so private health insurance, alternative to the original Medicare, A and B, which are more common. This may also include Part D, which is prescription drug coverage. Big changes in 2025, but this generally helps cover the cost of prescription drugs. The coverage gap has now been eliminated. In 2025, out-of-pocket costs are now capped at $2,000 for deductible, co-pays and or co-insurance. So many plans are merging or ending. So please review your annual notice of change carefully to see if it's been impacted. So these are the different parts affiliated with Medicare, but there's always important dates to remember. So the general enrollment period is January 1st to March 31st. Those missing the initial enrollment period can sign up during this period, but coverage will start July 1st. The first one here, the initial enrollment period, there's a 7-month period. Initial enrollment period begins 3 months prior to the month turning age 65 and ends 3 months after the month turning age 65. The Medicare Advantage open enrollment, again, which is the alternative to the original Part A and B. Again, the January to March 31st enrollment period only for individuals who already have an MA plan. And then generally the annual open enrollment period is October 15th to December 7th. Individuals can join, switch, or drop a plan coverage beginning January 1. So those are the sections related to kind of retirement planning, savings, the spending when it comes time to start taking distribution. So what are some next steps? So important considerations, work with your financial advisor and CPA to determine which account to draw funds from. Cannot stress enough the distribution strategies in retirement. Let's say you do want to retire at age 62. That doesn't mean you should start taking Social Security, right? Maybe it makes sense. It's optimal to start taking from retirement assets in different investment accounts and delaying Social Security until 65, 67. Or maybe it does make sense to take at 62 and you're not drawing from your retirement assets as early. There's many different strategies, many different scenarios out there. So it's important to work with somebody that can help navigate those waters. Remember inflation, right? Even if inflation is at 2.5 to 3%, that's still impactful, right? Your purchasing power going down by 3% every year just because the cost of everything has increased. Stick to the monthly budget, reassess your spending annually, right? Especially as new things come up, like, maybe you want to travel more, maybe you want to purchase a new vehicle, maybe healthcare has gone up dramatically. And then consider paying off high interest debt before retirement. So these are, student loans, maybe car loans. Generally speaking, if you own a home or, had in the last 3, 4+ years, your interest rate on your mortgage is very, very low. We have a lot of folks who, come in there like, well, I want to get rid of all debt before I retire, which makes a lot of sense. But if your mortgage rate is 2.5%, it might make sense to keep your investments or contribute to investment accounts because they generally are going to earn more than 2.5% a year, right? Again, a lot of paying off debt is psychological, which we totally get, but there is a time and a place to pay off debt and a time and a place to maybe hold on to it because the money you're using to pay down the debt could be earning more in a different area or a different bucket. So how TrustPoint and Emerge 360 can help. Um, what we do at TrustPoint is work with clients in financial planning, investment management, investment advice, some tax planning, etc. We have a relationship minimum of $50,000. That's not per account, just per relationship. We can administer, rollover 401ks, IRAs, joint accounts, custodial accounts, etc. So if you have outside retirement accounts or built up cash savings or received an inheritance or a divorce settlement, whatever the case may be, chances are we can administer those types of accounts. Ongoing financial planning. So we have a team of certified financial planners or CFPs that take all of our individual clients, through that. A dedicated team, local, and we have different tools and enhanced technology for clients. So again, if anybody has any questions on that, scan the QR code or give us a call to schedule a meeting. You may have seen an email on this, but 2025 Guide to Social Security. This is a complimentary booklet. So if you scan this QR code, I'll keep it up here for a minute or so, or you can give us a call and we will send you this booklet, which is pretty dense, but it has all of the ongoing changes that happen to Social Security every year and a lot of great information. So if you have any questions, get a copy of that book. The topics included are how to figure out your retirement benefit amount, delayed retirement credits when you receive the benefits. So scan that code to get the booklet sent to you. And then sign up for our monthly newsletter. We have different topics that come out every month. Expert insights, actionable tips, a whole range of different topics that we cover. Be the first to know about our upcoming webinars and events. But that is all I have. So I appreciate everybody for signing on today. Maybe I'll just leave it here for the Social Security in case anybody else wanted that. But appreciate you taking the time. Always good to see people online. Hopefully you found it valuable. Please follow us on social media. Please give us a call if you want to set up a meeting or want to chat through retirement accounts, our financial planning process. Any questions you may have about TrustPoint or Emerge 360, we are happy to answer. Look forward to seeing everybody down the road. Thanks, everyone.